Welcome to the UTI Swatantra series powered by ET Now. I'm Faye D'Souza. This week in our Investor Education Initiative, we talk to working professionals to find out how the SIP can fit into your monthly budget and how it can be the tool you use to invest for the long term. Quick round of introductions in the studio. Wonderful large audience this afternoon with a lot of questions for our guests. Hemant Rustagi, CEO, Wiseinvest Advisors. And Kishore Shetty, Director of KFIC Securities. Gentlemen, thank you so much for coming in. I want quick answers from both of you. There are a lot of options. If I want to invest, say, for my retirement or for my child, there are insurance options right now. There are mutual fund options. There are lump sum investments. I can choose an FD and put in whatever I can. What makes the SIP a smart investment for a working professional with a salary?
An SIP basically is an instrument which helps you to invest small amounts on a systematic and sustained manner. One. Secondly, fixed deposits are not investment options per se because they do not allow you to outperform inflation. So when you're looking at the long term and you're looking at goals for yourself, then fixed deposits are definitely not an option as such. It's always good to have an equity component in your strategy because equities always outperform on the long run. And along with that, with the positive government policies, equities have been given a tax shelter.
Even how do we quantify long term here? Because a lot of times we get investors who write in saying that I want to start an SIP. I'm not really sure how to decide how much that SIP should be, and I can't decide with asset allocation that I want. So obviously this comes down to deciding whether or not it's long term or not long term. What is long term technically in your book?
Well, I think there are two important aspects we need to look at. Unfortunately, whenever we talk about SIP, it's always equated with the equity, which is not the case. What is SIP? It actually allows you to invest a fixed sum on a fixed date in a pre-decided fund. So what it does for you, it brings in some kind of discipline. Most of the investors are not able to achieve their investment goals because there is no discipline in the investment process. The moment you sign up for SIP, you're committing that you're going to be investing fixed amount every month. So that is the beauty of SIP. Looking at what asset class you should invest in, I think the key factor is, like you said, there are issues always, how much should I invest and where should I invest? The key factor is very simple. Do a goal-based investment approach. You define your goals. You have short-term goals, you have medium-term goals, you have long-term goals. And if you're talking about a long-term goal, you said, what is the long-term? That defines your long-term. If I'm investing for my retirement, for example, which is 15 or 20 years away, for me, that is my long-term goal. And whenever we talk about retirement planning, there are two aspects you need to look at. One, you require a huge sum of money.
What if I'm going to retire in the next 5 years?
Exactly. Look, it always makes sense to start investing as early as possible for retirement. But if you have not done it, okay, the day you realize that this is the time for me, start it. The good thing about mutual fund is that there are investment options for you irrespective of whatever your time horizon is. You can invest in balanced fund. You still have 5 years to go. Focus on that rather than worrying about what you have not done.
All right, we're going to try and take in some questions from our audience members. Anybody in the front row with a question?
How do you compare various mutual funds? Is the net asset value a right indicator to compare the various mutual funds?
No, I think that's a complete misnomer. What is the NAV has no relevance at all. The NAV growth always happens in terms of percentage. You need to look at what is this fund suitable for you. First thing is you decide asset allocation. Don't go into the investment option straight away. Look at what your time horizon is. So, for example, investing for long term, then you look at well-diversified equity fund. Now the question is, which diversified equity fund, right? Practically, my view is that you should invest in a multi-cap fund to begin with. Because you need large cap, you also need mid-cap. It's very difficult for you to decide how much should go into each segment. Go for a multi-cap, primarily the fund which have bias towards large cap stocks. Go for fund which are consistently performing well. Now, when I talk about consistency, there are two things you need to look at. Every fund has a benchmark. See how the fund has done vis-a-vis the benchmark. Second is the peer group. Every fund has a peer group. I think to me, that is more important. See how this fund has done, in comparison to the peer group. So go for fund which are consistent. I think that's the key.
In fact, I also want to know, because a lot of times if I'm comparing my fund to either its benchmark or its category, I could look at the last 1 year, I could look at the last 3 years, I could look for the last 10 years. Ideally, what is that, range of comparison that I should take?
I'd first like to answer his question about NAV. Normally, you must manage your expectations. Normally you look at an investment proposition from one, protecting your money from inflation. And if you look at inflation in this country, it's traditionally around 8 to 10%, assuming. And that's where you need to invest to protect your money. And at 12%, you're making serious money. People, unfortunately, today are expecting returns of 18 and 20%. Even at 12%, I can give you a small example. If you look at only your public provident fund, which gives you 8%, and if you invest 5,000 rupees a month for the next 30 years, you're going to end up with 89 lakhs. That's an 18 lakhs of investment at 8%. And at 12%, that money goes to 1 crore 89 lakhs. A 4% differential results in a crore of increment in your savings. Now the question is, why do you need to take that kind of risk? You have to take measured. So your expectations should be managed. So when you look at NAV, people look at NAV and people talk about NAV. It's important to find out what's your expectation. And that's the key, not the NAV. It's the rate of percentage, what's the expectation. And you need to be sure about what your goals are and the percentage that will help you to achieve those goals, rather than being romantic about your 18 and 20 and 25%. You talked about long term, and you're not looking at long term. Long term is basically a goal oriented, as Hemant said. It depends on what you want to invest in and what are your goals for investing. If it's a marriage for a child, education. Today, education is the most expensive proposition. So how do you save for the rainy day? When your child suddenly becomes 18 and you have to get an admission to a medical college or an engineering college, and where's the money coming from? So as I mentioned to you, at 12%, if you're putting in 5,000 rupees, and as I said, you can calculate that mathematically, you go to 10,000 and that whole time frame comes down. You put 15,000. So what I personally advise people is to start small and gradually increase the pace of investment, depending upon your income.
Let's take a few questions on this side. The gentleman in the front, please.
Yeah, hi. I've been a working professional for the past 15 years now. I'm a little bit averse to investing directly in equity markets. So are there any mutual funds which have exposure to the debt markets as well? Thanks.
Well, of course there are. You see, the misconception about mutual fund is that they're all about equity. I think the good thing about mutual fund is that they offer a product to you, even if your time horizon is a day or 1 decade or 2 decades. There are a number of options. They allow you to invest in different asset classes like equity, debt, and gold. Now, you said you're averse to equity. Yeah. Obviously, I'm sure you have your own reasons why you're averse, because you must have heard people losing money, or maybe you have lost money in the past. I think it's all about how do you invest and what is the investment approach. Equity investment, for example, it requires a time commitment. It requires 2 things. One, you need to think long term. The second thing is you need to invest systematically. Yes, as you said, there are different funds which invest. There are hybrid funds. Today, for example, there are funds which invest in equity, arbitrage, and debt. Okay, now you can decide what kind of risk you want to take. If you say that not more than 25-30% of my money should go into equity, there are products you can design a portfolio. But again, my advice to you would be rethink on equities. Okay, for the long term, you need to beat inflation. There are 2 risks that we take in our investment. One is the risk of losing capital. Unfortunately, we always focus on that. For a long-term investor, the biggest risk is inflation. The moment you keep your eyes off inflation, suddenly what you'll see when you get there, you will see a huge gap in what you needed and what you have accumulated.
All right, we have to take a very quick break, I'm told, but we'll come right back and answer more questions. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET. Now we have a raging conversation going on in the studio right now about whether or not we should be using mutual funds and how long you need to stay invested. Right, I want to take a question from the lady in the back.
Hi. So basically, when we are comparing the returns on mutual funds from 1 to 3 years, generally what we find is returns over 1 year is higher than the returns over 3 years. So question is, how long do you stay invested? Should you exit, after 1 year? Or should you stay for 3 years or more?
If you look at last 1 year, the markets have done very well. So you'll find that average return is around 48-50%. If you look at a mid-cap fund, maybe much higher. And the reason why the 3-year return will be lower than that, because that's an annualized return, right? This is the absolute return. So the impact of that getting into the yearly return over a period of time takes time. So which is not to say that every time this happens. This is not a trend. It happens during the time when the markets suddenly, start moving upward.
If I've noticed that my mutual fund has done really well over the last 1 year, there's a temptation to take the money out and say, okay, I want to take this money out before the stock market comes back down again. And I know there are a lot of investors who do that, and timing the market is very dangerous. So is it important then for me to remember the goal that I put this money in for?
Yes, absolutely. You see, I tell you why this happens. It happens because somebody comes and says that you can make good money in equity, and the best way is that if you don't have lump sum, start investing through SIP. So you start investing SIP. The mistake most of the investors make is they don't have a defined time horizon in mind. And everyone is focusing on making money. So the SIP does not protect you from the risk which are there associated with the asset class. It reduces it. It allows you to benefit from volatility over a period of time. So I think the key factor is if you define your time horizon. For example, someone who is investing for a child education or retirement planning, you have 15 years to go, 20 years to go. Why should you worry about volatility today? I think keeping a goal in mind and time horizon in mind allows you to stay put. When you don't have a time horizon, you don't have a target. We talked about if I made 30%, what should I do? My point is I want to accumulate a corpus over the next 20 years. Why should I worry about 30? And what you do is 2 or 3 years before you retire, start transferring some money to debt to protect all your gains. Not completely, but that's the way to go about it. Allow it to accumulate during your defined time horizon.
All right. I will take a question from the back here. Yes,
the insurance-based retirement plans are better, or investing in a SIP is better?
You have two different needs. You have insurance needs, you have investment needs. The moment you're looking for a product which puts everything together, somewhere you're losing your focus, somewhere you're spending much more. For example, if you look at that kind of option, okay, the returns are going to be very, very low. You can see that expenses are going to be higher. When we talk about SIP, it allows you flexibility. It allows you to increase the amount when you want it. It allows you to put money in the asset class that you want. There are many more options available from the mutual fund than what the insurance company can give you, even within an equity. If you happen to be an aggressive investor, you can look at some mid-cap fund or some large-cap fund, or depending on what kind of profile you have. So, if you separate these two needs, what then happens is you go for a term plan, for example. A term plan, as we all know, you buy online, is very, very cheap, right? In these kind of plans, you will not get the kind of insurance cover you should have. Okay, it comes as incidental thing to you. You need to look at, if you apply the thumb rule, for example, if your income is, let's say, 10 lakh per annum, so the thumb rule is at least 10 times of your income you should have insurance cover. So go for a term plan and then invest separately through mutual fund. Like I said, it gives you more flexibility, more potential for return. Expenses are going to be lower. And I think the performance-wise, my view is, what I've seen in the past, this is a better option.
Kishore, I want to bring you into what you said about inflation when you were talking about it.
Precisely.
If I do a traditional plan, I'm entirely in debt and I'm not in equity at all. So
Absolutely. See, in elaborating on what Hemant said, what you need to do from an insurance point of view. See, insurance is just a risk coverage. It's not an investment vehicle. So what we do normally is that we invest, we take an insurance policy, as he said, a term policy, which is good for the buck, and ensure your financial plan. So when you make your financial plan and say you're 40 years and 20 years down the line, you need around 4 crores to maintain your present standard of living, considering the inflation rate, then you need to understand that you need to have 4 crores. But something untoward happens to you, and what happens? At least your family will get something from a term policy. But if you take a traditional money back policy or a endowment policy, unfortunately, can I ask you what's your age?
I'm 40.
40. Probably if you take a 50 lakh policy, you would probably paying around 30 to 40,000 rupees, 30,000 rupees term policy, a term policy per year, annual premium. But if you take for 30,000, you'll have to pay an endowment policy or a money back policy, you would probably get 5 lakh coverage or 5 to 6 lakhs of coverage. So it doesn't make sense. So what you need to do is take a term policy and juxtapose that with your financial plan. And as you achieve your financial plans, and the biggest advantage of a term policy, I always say, a term policy like a comprehensive car policy. Nothing happens to the vehicle, you don't get anything. Something happens to your vehicle, you get your policy amount. And that's why term policies have been unpopular, because Indians as a psyche have been led to believe that insurance is an investment option, which is, I'm sorry to say, I have strong views on this. It's not an investment option.
Let's take a question from the ladies.
My question is on the capital protection fund. Professionals like us who have been working professionals, and we have been saving through monthly expenses and through SIP. and mutual funds. So is it advisable for us to go for a corporate capital protection funds?
When you talk about capital protection, typically these are closed-ended funds. So what they do is they invest 70 to 80% in debt and the rest goes into equity. If you are investing for protecting your capital, you better not invest. You want to make your money grow without taking undue risk. So when you define your goals, when you segregate your goals and you invest accordingly, go long-term, go in equity, short-term, go into debt. Even when investing in debt, for example, look at options like mutual fund, which can give you higher return than what the traditional option can give you, and maybe the returns also are tax efficient. So look for tax efficiency there. Look at different options depending on what your goal and time horizon is. Don't look at a ready-made solution saying, okay, if I'm investing here, my capital is safe. Then, as I said, then there's no point in investing if the focus is on safety of capital alone.
Right, I'm required to take a very quick break, but when we come back, we'll also talk about how to review the fund that I'm invested in and decide whether I should continue or I should get out at some point. That's on the other side. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're talking about using monthly SIPs to save for long-term goals like your retirement or your child's future. We have more questions to work through in the audience. The gentleman in the back, go ahead.
My question is related to asset under management. Now there are multiple funds available under each scheme, so consistent performance is definitely one of the parameters. Is asset under management under each fund should be one of the parameters to look into?
So Hemant, this is interesting. We have in the mutual fund industry what is called a long tail, which is basically this long list of funds with 200, 300 crore rupees assets under management that nobody pays attention to. And then there's the worry that when a fund becomes too large, that it's no longer nimble enough to navigate the market. So is there a sweet spot that we should be looking for, or do you think it doesn't matter?
See, I won't say straight away that AUM does not matter. AUM does matter. Where does it matter? You need to see which kind of fund you're investing in. So for example, if you're invested in an equity fund, which is investing in pure large cap fund, I don't think the size of the fund matters at all, because there is enough liquidity in all the stocks that we're looking at. I mean, you have funds which are today at 8,000, 10,000 crore, doing much better than the funds which have 3,000 or 4,000. So if you've invested in a large cap fund, don't bother. If you've invested in a mid cap fund, the size matters. Why it matters? Because the key in success as far as the mid cap funds are concerned is the stock picking. There aren't too many opportunities in the market where fund manager can go and pick up mid cap stock. Now the leaders in that segment would be the ones who do stock picking very well. The moment their corpus become very large, they will not have opportunities to invest. They'll start doing exactly what the next fund manager is doing. Then, the edge that you had over others will go. So for a mid-cap fund, if it is a small, even 100 crore fund, I don't think you need to bother. In fact, it's very good that a small fund can actually give you, much better stock options there. So look at the kind of fund you're invested in and then take a decision. For example, if you're in a debt fund, liquid fund, it can be 30,000 crore, it can be 40,000 crore, it doesn't really matter.
Gentleman in the front.
Yeah, that majority of the people who are investing, they are not financial experts. And they are not able to monitor the NAV, they are not able to monitor the market, they are not able to decide the options, when to change, how many times it will change. And it has happened also in my case, that whenever you invest in insurance, when you invest something, at the end of the day, they say, no, these returns are hardly anything, you should have changed the NAV, you should have checked the NAV, you should have changed the options. So, especially when we invest in some big companies, we do not expect, individual again to keep on monitoring that. So, how do you really sort out this matter? Secondly, between two financial advisors also there is a contradictory opinions. One fellow says you should have gone for this, not for this. So that is one more thing.
First of all, how am I supposed to track all of my investments in various categories, but not just mutual fund? How important is the advisor or the person who's looking after my money?
Well, look, today, fortunately for investors, there are two options. One, you can either go through an advisor or you can go directly. If you go directly, you save money. But only thing is, don't focus on that saving that 1% or 2%. You need to be very confident about your money. See, all of us work so hard to earn the money. You need to ask yourself this question: do you really understand, do you really know how to pick the right fund? And you mentioned the issue is, when do I rebalance my portfolio? When do I come out of it? Too much churning is never great. You will always find people coming and telling you, get out of this, is not done well. That is not the correct approach. The point is, 90% of your return will come from the asset class. It's very important for everyone to understand. If you remain in equity, believe me, even if you're in the worst fund, you will still get much more money than what you can get elsewhere when you invest in fixed deposit or somewhere. The problem with us is that every time the market goes down, the first thing that we want to do is exit from there. The moment we see the market going up, the first thing we do is come out of the debt and come into this. When you maintain your asset allocation, your exposure to different asset classes remains. So whether the market goes up, whether the market goes down, you benefit. And second thing, the issue that we're discussing here is, if you maintain the discipline of investing on a regular basis, okay, you should be happy when the market go down because you get more units for the money that you're getting. So focus on the asset allocation, not so much on the fund.
Sure. Now, we're lucky here, the three of us all agree on the basic concepts, but if we actually went around the room, we'd find people who disagree in the manner in which you should invest. So what do you do when you get two different opinions? At what point do you stop taking second and third opinions from, advisors?
We are in an age where information is an explosion of information, and a lot of clients get confused about the contrary advice that they get from their counselors as well as from television. And when they come, what we try to do is basically, education is the key. I always say, it's your money or advice. You should be as good, because it's your money. You should know what this guy is talking. So that's very important, that you must understand your risk, appetite for risk. That's a key factor in your strategy. You should also be clear in your mind, and you should also be educated about your own money. It's your money, my advice. So that's very important.
Sure.
Look, I think we all need to start looking at equity differently. Every time we look at equity, look at it as a passport to riches, overnight riches. Okay, I'm going to make money. What happens when you invest in equity, whether directly or through mutual fund? Even when you invest through mutual fund, your money goes into different stocks. When you invest in those stocks, you actually become owner of that company to the extent that your investment is. The moment you start thinking or behaving like owner of a business, your thinking about equity will change. Don't look at equity as something which is going to make money all the time. As we all know, we run our businesses, we understand, right? There are going to be ups and downs. So the moment we start looking at equity like this, I think you can really benefit from that, because world over, investors have made lots of money from equity. It's just that we need to change our outlook on how we look at equities.
I had a question. Throughout the show, you mentioned debt mutual funds. So are debt mutual funds safe investment for senior citizens? And is that investment risk-free?
There's a basic difference in a traditional option and a mutual fund. The traditional options, we're talking about bond, debentures, and fixed deposit. Primarily, let's say fixed deposit. You get a guaranteed return, and you have safety of capital. That's why most of the people go there. When you invest in mutual fund, you're investing in market-linked product. Okay, whether it's a debt fund or an equity fund, there are always risk. Now you need to understand, in debt fund, your time horizon is very, very important. Okay, so if you have a short-term money, for example, money you want to keep aside for a couple of months, you go into a liquid fund. You will get much better return than what you can get from saving bank account. If you're doing recurring deposit for a year, go into a short-term fund or go into an arbitrage fund, for example. They're absolutely safe. You'll get much higher return than what you get there. If you go for a longer term horizon, 3 or 4 years, then you go into, let's say, a duration fund, then you need to look at how much money you want to invest in that. There are always risks. The key factor is choose the right kind of fund. If you invest long-term money in liquid fund, you will be a loser. If you invest short-term money in a debt fund, which is meant for long-term, you will be a loser. Choose the right fund. And as I mentioned earlier, if you invest for more than 3 years, your post-tax return is going to be much higher than what you get elsewhere. So even whether you're a senior citizen or at whatever stage of life you may be, there are funds for you.
And to add to that, a fixed deposit, from a tax point of view, is not tax efficient, because you're guillotined. Every year you're paying tax on your interest. But in a debt fund, after 3 years, you get an indexation benefit. So practically, when you look at it, the indexation is linked to inflation. So at the end of 3 years, practically you would not be paying any tax. So a debt fund is a very tax efficient instrument, and it is definitely a part of your portfolio for a retired person. In fact, for everyone, as part of the asset allocation.
All right. I'm being told we've completely run out of time on this show. Gentlemen, thank you so much for joining us in the studio and answering our questions. Thank you for being such a wonderful audience. It's been a pleasure to have you here. If you're watching at home and you'd like to join us on the show, you can always reach us on our website, indiainvestkaro.com, or you can send us a question on Twitter, #InvestKaro. Thank you so much for watching.